Welcome back to America's Commercial Real Estate Show. I'm Michael Bull. This segment is brought to you by Valuate Online Investment Analysis. Check them out. Their site is getvaluate.com. Well, today we're talking about multifamily. The name of our show is Multifamily Sector Sliding as a Question. And I'd like to ask that to Jim Costello, who's joining us on Skype. He's Senior VP with Real Capital Analytics. And Jim, you guys do a great job of tracking the investment sales market of all property types. And, I think multifamily's been a really hot market. What do you see for a deal volume and then kind of the appetite for multifamily today?
Yeah, thanks for having me here. I tell you, it's been interesting. Multi-housing was the sector where deal volume was growing even as others started to slide. It was the first one into the recovery period that started to see growth. And into 2017, it has given up ground. Deal volume now is down 26% year over year through April, and our preliminary numbers through May, really show maybe about 40 billion in volume so far for the year. In 2016, the deal volume through May was 60 billion. So you're missing 20 billion in deal volume. And that is something that has people on pins and needles because they're worried about, hey, if deal volume is falling, what happens next? Is this a sign of buyers pulling back and prices are going to fall? And the specter of the downturn after the global financial crisis is on everybody's mind.
So why do you think deal volume is slowing down?
Well, there's a couple things. On the one hand, deal volume is falling, but prices are still high. We haven't seen any change in pricing yet. In fact, in some cases, cap rates have actually compressed, even as deal volume is falling. To me, this says that sellers are pulling back. In fact, at the ULI meetings in early May, talking with a number of acquisition professionals there, one of the issues that they were complaining about is that they just weren't seeing many high-quality offering packages on the market. If you are an owner of a nice cash-flowing apartment property at this stage in the cycle, why do you sell it? If you sell, you get some capital back, which is great, but where do you put it? It's not like you can replace the great ongoing yield with a better investment at this point. Now, there's always somebody who needs to sell. Some sort of fund comes to an end of life, changes in business models. So there's still deal volume. But some of the best deals have already happened so far in this cycle, and sellers, just are not bringing things into the market in the same way they had. Buyers are still hungry for yield. There's still a wall of capital worldwide looking for yielding assets, and bonds just can't deliver. But there's only so much they're willing to pay, and there's a bit of a disconnect between what buyers are willing to do and what sellers want for their current assets.
Yeah, and if you've seen cap rates really still decline in multifamily in your most recent sales, then some people may think that that sector is kind of priced to perfection.
Well, and what's also interesting is there's a bit of a bifurcation in terms of the kinds of changes in cap rates by property type. The mid-high-rise kind of space, we've seen cap rates really flat since early 2016. Really anywhere in the range from 4.9 to 5.1%, kind of around 5. It bumps up and down a bit every month. Whereas the garden apartments was at about a 6 in early 2016, and now it's at around 5.5, 5.6. So garden apartments have seen prices, cap rates continue to compress. And it's actually seen stronger deal volume in the sense that it's least worse in terms of a decline. Where we are seeing the biggest pullback is in the areas where things are the most expensive. In fact, the top markets, the top 5 markets for year to date in terms of deal volume include places like Baltimore, Orlando, Jacksonville, St. Louis. These are all markets where the average apartment cap rate is closer to a 6%. Now that's 4 of the top 5. The actual top is Orange County, which is a very expensive area, around 4.5 for cap rates. So it's not, the story doesn't entirely hold. There's still some investors looking at some of these high price locations, but generally speaking, the high price locations are seeing deal volume pull back the most.
Yeah, and it sounds like you're kind of explaining a bid-ask gap is maybe part of the problem, or where sellers are expecting these really low cap rates. Buyers are thinking, "Hey, it's priced to perfection." Is that one of the issues with volume?
Yeah, it's easy for buyers and sellers to come together in an environment of falling interest rates and falling cap rates, because as a buyer, you can go into an acquisition, and even if you think that you might be underwriting a little loosely, and maybe there's going to be a problem with that, you can kind of paper it over with cap rate compression in the future. At this point, though, nobody really expects interest rates to go any lower. And
Right.
with that, nobody really expects cap rates to go much lower, except for some of the secondary markets, some of the other property subtypes for apartment. So you have that situation, and buyers just have to sharpen their pencils more. They can't be as aggressive as they were just a year or two ago.
Yeah, and I'm just keying on that what you just said, that no one expects cap rates to compress much more. And then you mentioned maybe there's some secondary markets, or maybe is that kind of B and C product where there still could be some upside on cap rate compression.
Yeah, and the challenge at this stage in the cycle, though, is that investors are still hungry for yield. They're looking for it wherever they can find it. What you always have to worry about is, am I taking on risks in terms of exit liquidity that I may not fully appreciate when I'm doing the acquisition? That's the challenge with prices at these cyclic highs.
Yeah, and this discussion reminds me of one of those famous sayings that we've all heard: buy low and sell high. So if you are a seller, that would seem like this would be a great time in the market if we're priced to perfection. We've got lower interest rates than we expect to have next year and the year after. It would seemingly be a good time to sell, I guess. But to your point earlier, well, what are you going to do with the money? Where are you going to go?
There you go. That's an issue, because if you are already in the investment and you've been there for a couple of years, you have some great cash flow in place. There's going to be some people who make that decision to sell. There's other reasons to sell. A fund comes to the end of the life. There's a number of issues why someone might sell, but for some investors, it may just make sense to hold the current cash flow.
Well, it's always interesting because you never know really what's going to happen in the world, right? In the U.S. and what's going to happen in other countries that could impact our economy in the U.S. And I think as a long-term investor, there's certainly a lot of investors that say, look, don't wait for the last dollar. Maybe if things are up, it's time to take some money, some chips off the table. So let me ask you this. So you and I, we're in the business of interpreting investment analysis and thinking about the future. So we really have to think about, well, what if I do keep this asset, or I buy this asset? What are potential cap rates, say, 3 years from now? If we're expecting Fed increase a couple bumps this year, are we expecting 2 or 3 the following year? What might exit cap rates be 2 or 3 years from now? Or as a change, if you will?
Yeah, this is a tricky issue. If I could forecast where interest rates are going to go, I'd be in a different business. But I don't think that the long end of the yield curve, think of the 10-year Treasury. I don't think we're going to go back to something like long-term averages. I don't think we're going to go back to something even before the financial crisis. There's some changes underway in the world. The Fed, remember, they only control the short end of the yield curve. They control the Fed funds rate. They don't control the 10-year Treasury. Through the quantitative easing programs, they were trying to influence it, trying to buy assets and drive that price down. Now, they haven't been doing that of late, but they still have a big book of assets on their balance sheet. So if they start to unwind there, maybe that creates some upward pressure on the long end. But at the moment, they're just kind of sitting still. I think the bigger issue is that there is still a wall of capital worldwide in the developing world that wants safe, steady yield from assets in the developed world. And I think that that more than the actions of the Fed will continue to make the environment in the future low interest rates and generate lower cap rates than people in our industry. Folks like me and you have been in this for a bit, lower than we are used to for most of our careers.
So let me translate that. If I'm a listener or a viewer, you don't expect cap rate increases in 2 or 3 years from now to hikes and cap rates to be that significant.
I don't think cap rates would go back to sort of their long-term averages. That's one thing that people like to look at. What's the long-term average? Where are we today? And they make an assumption we'll just go back to that eventually. I don't think it's going to, for simple reasons that interest rates, the things that drive the long end of the yield curve, the amount of capital looking for that yield, there's still a vast wall of retirement money worldwide that's looking for that safe yield, and I think that it's going to create downward pressure on yields worldwide for all asset classes.
Yeah, that's a good point. I think commercial real estate and, of course, apartments are kind of bulked into that. Has become, a safe investment, and it's gotten credibility around the world as something to invest in. Well, Jim, before you go, what tip would you leave our listeners with related to the multifamily market?
Don't panic. People see this falling deal volume, and they start to get a bit worried. Yeah, I think it's just a matter of the market adjusting in the current time period, just trying to figure out sort of how much more should we pay. The other thing I'd watch for is just what's happening with construction. That's the one thing that I think might, in certain select locations, begin to undermine performance. Where I live, for instance, in downtown Brooklyn, here in New York, there's a number of towers coming in, and it's starting to depress rents. But you can watch it. I don't think it's forever. There's still demand in some of these areas. It's why they're building some of these projects.
Yeah, that's a good point. And to add to that, I think watching employment growth and where do you expect the employment to grow? We're here in Atlanta, and I think our employment growth is expected to be strong. We're building a lot of apartments, but they seem to be leasing up well. And Jim, good information as usual. Thanks for being on the show.
Thank you.
And if you'd like some more information from Jim, we'll put their website link at creshow.com. And thank you for joining us out there. We really like hearing from you, connecting with you on LinkedIn, on YouTube, on Twitter. Thanks for connecting with us. Leave comments if you're listening or watching to the show. And be sure and join us next week. We'll have another great show for you. And until next week, be sure that you always lead, learn, and laugh. And join us for America's Commercial Real Estate Show.